The trade deal, which we're calling a phase one deal between the U.S. and China, may put a brief hold on trade tensions, but it does still pose economic challenges for countries that directly compete with U.S. export markets. David Rosenberg is chief economist and strategist at Rosenberg Research. Great to have you with us.
Thank you.
So I was curious for your take on this because the markets were so anticipating this. Obviously, there are some numbers, 250 to believe President Trump that a new billion goods and services that could be traded. But just in terms of what it changes in a macro way on tariffs, not very much, right? I mean, there's some positivity here, but it's not as though we're back to square one.
Right. And it's hard even to really know how much of this ongoing rally in the stock market really has anything to do with trade, because it's just a tide that continues to lift all the boats. You can't even really differentiate between companies that are geared towards trade and those that are not geared towards trade.
Yeah.
Because I think the overriding story and the really big inflection point was in early October, when it wasn't really much about phase one. It was about when the Fed released its memorandum that it was going to start to embark on QE4, although it doesn't call it QE4,
right.
To rectify the situation in the repo market by providing gobs of liquidity
Yep.
into financial assets. And to me, that's the really big story here. But yeah, you're 100% right. I think that, the overhang, and you saw this in the Fed's Beige Book yesterday, ongoing comments, I think, from 10 different districts on the tariffs that are in place. They are not going anywhere, and I think the effect is starting to cascade. And you could see it, for example, some businesses saying that they can't pass on the cost increases, so they're taking it on their profit margins.
Yep.
Well, that'll come at the expense of employment or some other spending. And then the ones that can pass it through, well, that's being hit on the consumer. So there's no doubt that this is having a negative impact on the economy, and the administration wants to keep those tariffs intact as a bit of a weapon. Or, to be more polite, maybe incentivize the Chinese to come back and embark on phase two. But the tariffs are intact. They're having an ongoing pernicious impact. And for any business, for people out there that think that the corporate sector is about to go into a capital spending spree because we had this kumbaya moment with phase one, I think going to be sorely disappointed.
And it's interesting because some of the pain that you would have felt more immediately, I think, from the tariffs, from the real business costs associated with those tariffs, has been masked because big businesses still have the benefit of those tax cuts. The Trump administration, I was just looking at the numbers of Wall Street banks, still through 2019, massive benefits from those tax cuts. So you
Right.
wonder what would have been if you didn't have that offset. Which kind of gets me to, I want your take, because we talk all the time to people now, we talk all the time to people who are involved in the markets, who are full participants. I've been doing this long enough to know that the people who are fully involved are the last ones to say the theater's on fire, right? Mm-hmm. They're just not geared in that way.
Right.
But the disconnect between the fundamentals and what's happening in equities is there. People can feel it. They know their own real life hasn't changed, even though unemployment is low. I mean, it's just kind of the real economy versus what's happening in the stock market. What are you looking for the markets to, as you say, stop being traded as, the rising tide lifts all boats and start being traded more on a fundamental basis? What will make that happen?
Well, I don't know when that's going to happen. I think, though, that the market is going to have a lot of difficulty if they start to hear this one particular word, which is called the taper. Right. And we all know what happened when Ben Bernanke, God forbid, in 2013, used the word taper when it was regarding pulling back on QE3. What happens when we get the Powell taper? Because this is not a permanent solution as far as rectifying the situation in the repo market to continue to expand the balance sheet unsterilized. I mean, the Fed is actually expanding its balance sheet more now at a faster rate than it was with QE3. And we know what QE does. In fact, in the other quantitative easing episodes in the past decade, the correlation with the Fed's balance sheet and the stock market was 70%. Historically, it was close to zero because the Fed's balance sheet was stable. In this latest go-around, in the past, say, 3-4 months, that correlation between the stock market, the Fed's balance sheet is 95%. So you asked me the question, at what point will the stock market start to undergo a more serious correction? And it'll happen just as it happened, which is completely normal. We saw what happened in the fourth quarter of 2018. Nothing moves up in a straight line. This is a classic liquidity and momentum infused melt up in the stock market. It's no more sustainable now than it was, for example, in January 2018. And everybody extrapolated what was happening into the future. I remember saying at the time, how come, they were saying it was the best January since 1987. I said, it's funny, when I poll people about 1987, they didn't remember January. They remembered October.
Right.
I remember what happened in October 2018. Wasn't a pretty picture. So I think that actually this is all about liquidity. And as soon as the Fed starts to taper or start to pull back on this provisioning, the stock market is going to have some trouble with that because the valuations are so extreme.
We've started to see signs, and we've been talking about the credit cycle for a while, and that it's long in the tooth, and certainly that the quality deterioration is there, right? We've started to see covenant-free, covenant-light, all this kind of things you worry about in the high-yield market. KKR now saying they're watching those names that can be downgraded, right, and tip over from creditworthy into high yield. Where are you on that in terms of just the health of the credit market and what we need to be thinking about it? What would cause that to happen?
Well, I think that what will cause it to happen is that we'll go through a default cycle or a delinquency cycle, and you hear all the time that there's no recession. Yet what's very interesting, there's no recession. Yet there's no technical GDP recession because 70% of the economy, called the consumer, I call it Consumerica, hasn't gone down for the count because employment's held up reasonably well.
Yeah.
But the other 30% of GDP, the non-consumer segment of GDP, and 30% is not 70, but it's not insignificant. Yeah. It's been in recession for the past 2 quarters. It's actually in a technical recession. We know that we're in a deep profit recession right now, and the profit recession will cut into something very important from a debt servicing standpoint, which is corporate cash flows. And this all happens with a lag. So right now, the question is, are you compensated not just at spread levels, but at yield levels in the corporate credit space for even a moderate default cycle? No way.
For the risk you're taking.
We have never had, you can look at corporate debt. What's interesting is that the bulls will say, well, net out cash. Like most of the cash is 3 companies,
right.
2 healthcare and 1 tech company, so the cash is not evenly distributed.
Yeah.
When you look at corporate debt to GDP or corporate debt to EBITDA, it's at a record high. And yet we have credit spreads in the aggregate, 200 basis points below the norm. So no, you're not getting compensated for the risk out there in credit, not a bit.
You've started this new life, Rosenberg Research. Obviously, you bring all of your previous knowledge to it. You haven't changed your views because you've started a new business. But just as you sit here today, just your view on Canada. You have obviously there's lots to concern in the world out there. Are you pro-Canada these days on a relative basis?
Well, I'm pro-Canada because I love living here. But there's a difference between living in Canada and actually investing. Yes. It's a tough place. Look, I mean, we have a federal government. That continues to think of taxes or tax reform or tax relief for individuals and for the middle class. And I think that's just beautiful politics. But the one thing that was never addressed after the U.S. cut corporate tax rates is we never made ourselves tax competitive again at a business level. I think that the problem in Canada, in my opinion, is we have governments that somehow have convinced people that businesses are not people. But guess what? Businesses are people. And they hire people, and we have an inherently competitive, uncompetitive tax regime here. So in a situation where if you are a company making a business investment decision in North America, you're more incentivized to book your revenues in the U.S. than you are in Canada. And then we have a situation, the Canadian consumer is so debt-strapped right now. And when you take a look, this is still, it's not 70% of GDP like it is in Consumerica, but it's 60%. Yeah. But look, the Canadian household, after you've paid your taxes, after you've paid your interest and principal, after you've paid your rent and your utilities and your education and your health care, you're left with barely more than 30 cents on the dollar to go spend on discretionary. So I think that the big story in Canada ongoingly is immigration. But it's masking the fact that real per capita GDP in this country is in secular decline, and that's a problem. And that's why the Canadian dollar is more likely to go down than up over time until that gets turned around.
Lots to talk about next time. Dave, great to have you here.
Thanks, Amanda.
David Rosenberg is Chief Economist and Strategist at Rosenberg Research.